Hi, everybody. This is Tyler Lively with Sound Planning Group. I wanted to share with you a video that we filmed actually a little while back. It was David Stryzewski, our CEO of Sound Planning Group, and our Chief Investment Officer, Joe Maas. And we're making it public. Again, it's called Investing in the 21st Century. And we have found it to be able to give great highlights and education and resources on investing in the 21st century because it's different. Times are changing. Rules are changing. Especially as you get prepared for retirement, the rules change. So having two experts come and talk to you, and in addition, again, to our viewers, we're hoping that it can again be another resource, but buckle up. It's over an hour long. It's a ton of education, ton of resources. We hope you enjoy it, and stay tuned. We'll continue to provide educational content coming up.
Welcome to a time that I'm really excited about here with Joe Maas, who is our Chief Investment Officer here. And we've got Joe in-house to be able to kind of go through and talk about some of the portfolio modeling and the ideas that are really going into the sophisticated math and science way in which we're looking to manage money. And so we're going to endeavor to keep this short. Now, just on the front end here, just know that Joe Maas is a clock builder. And so he wants to tell you how the gears swing, at what rotation, at what speed, and that's awesome. What I'm going to be endeavoring to do is make sure that we're just talking about what time it is, because we can get super deep. Now, my guess is that many of you are going to have questions as you're going through this time. And so I want to encourage you to just put your cell phone to the side, grab a pen, grab a piece of paper, use the restroom if you need to do it right now, because the next 90 minutes or so are going to be a great opportunity for engagement and just kind of getting some better information, more information on what's actually going on in the world of investing. What are the things that you need to be aware of? So,
yeah, thanks, David. Hello, everybody. Yeah, and so remember, you guys have been through 1, 2, 3 classes. This is kind of the advanced investment class. So it is supposed to be a little deeper than what you've been through. And that's why it is, it's the 4th one in the series.
Yes, sir.
So I will do my best job to tell you what time it is. But we do want to share some of the secret sauce behind the scenes so that when we tell you that it's 11 o'clock,
right,
you trust us. It's not, well, hey, David, was it 10:45? Joe, what time was it? You're going to go, you know what? They know what they're doing. They got it. I believe them. So we're just trying to educate you here. And we do have to go into some of the details to do that.
Absolutely.
All right. So, today we're going to talk about a really cool new model that we made called SAM. Stands for Strategically Aligned Asset Management. Risk management, investing, asset allocation, a bunch of things that are changing, what drives the market. And if we have time, David, maybe we'll even talk about how professional institutional fiduciaries like SPG actually build portfolios with building systems.
Absolutely.
Sound fair?
Yes, sir.
All right. Well, David, do you want to start off telling us about SAM, and then I'll add in with that a little bit as well?
Perfect. So SAM stands for Strategically Aligned Asset Management. Ultimately, what we're endeavoring to do here is try to get 2 fiduciaries. So there's really 2 roles in a financial life. One is we've got to get the financial plan right. The second is that we need to get the engine right, the investment modeling right. How are we actually projecting and going forward and making sure all the math and science on this is correct? Because when we intentionally unemploy ourselves, right, with this thing that we call retirement, we want to make sure that it's right.
That's right. Yeah, so I've been doing this for 30 years, and 30 years ago, a single advisor, David, was able to do everything, right? They went out and hunted, they cooked, they did the dishes, they were the waiter, the cook, the chief bottle maker, the whole bit.
Right.
In today's world, as you probably noticed, especially after COVID, but even pre-COVID, the world's accelerated, right? The speed of change with geopolitical issues, with tax laws, with the market dynamics of high-speeding trading and meme stocks and flash crashes. There's so much noise going into the market now that what we needed a new, better model. And the industry's failed really to give us that model. And so what we did is when we looked at what we needed a system to evaluate all the critical facts, right? Use all the math and science, and really to blend that financial planning, which is so important, with the investment management. Yeah. And so we needed a new way to do that. So that's why we, put our heads together, and that's what we do. We came up with the model called SAM. So it's a better model to, deliver products and services to you. And like David said, you get 2 fiduciaries for the price of 1. We'll talk about that in a moment. So, SPG acts as your chief financial planner, at a fiduciary institutional level. Right. And then I act as the chief investment officer. So what that allows us to do is it allows me and my team to stay focused in the models, the markets, the economics, right? The managing of the money on a daily basis. Well, the financial planning team does everything else. And so by having two of us, you get to get a lot better result than going to, there's many good financial planners out there that are trying to do everything themselves, right?
Not going to work.
It's not going to work. And so, in 10 years from now, we would hypothesize that if a client isn't working within a SAM model, a strategically aligned asset management system, you're probably in a broken, outdated model. And David, you talk a lot about in class about good, better, and best and the advisors. You want to touch on that or relate that a little bit to SAM and how that might...
Yeah.
People might have had some education on that before from class.
Yeah. So what's very common, and maybe it's good enough, I'm not sure, is that most financial advisors have like one way of doing things. And so possibly two different money management models, but not a lot of variation within it. And so what they say is, hey, you come in, you take a basic risk profile, and this is the portfolio that we put you in because you're conservative, you're moderate, you're aggressive, whatever. And so what the SAM model endeavors to do is, you'll find out in just a little bit here, is that we've got 22 different individual models that we're running simultaneously. And so as you go through this, you're going to better understand, oh my goodness, I do want to be in individual stock models. I do want to be in some more actively traded type of models that can be dynamic, maybe some metal models, maybe some real estate models. And so what we're endeavoring to do is to take you from a good position to a better position, and ultimately try to get the math and science right to define what might be best given the hour that we live in, your risk tolerance, your need to take risk in order to get the right rate of return. And so the collaboration between the financial planning and the money management is really what we're trying to get to here today. And so that's what we're endeavoring to be able to share with you in a compelling way. But most people would have to leave their advisory relationship just to get a different type of money management model. Yeah. And they're not really doing that math and science approach.
Yeah. Great. I appreciate that. And hopefully you do too. So, again, like we said, you're getting two fiduciaries for the price of one. And the reason we say for the price of one is that we are the manufacturer. Right, David? There's no middleman. Right. You got two fiduciaries and we're right here. And so a lot of advisors, they go to a firm who goes to a TAMP, who goes to a money manager, who puts them in mutual funds.
Right.
And David, I know you and your team do a lot to expound on all the hidden fees.
Right.
You teach that in class about the mutual fund fees and all the hidden fees.
Right.
Well, our SAM model just eliminates it. It's a very flat model. And so you're getting the two principal decision makers, the two fiduciaries, for a lot better value.
Right.
So lower fees means better returns.
Absolutely.
Okay. So again, we're just not another money manager, right? The SAM model provides these two fiduciaries. And on the first fiduciary, the first step is to go through a discovery process, right, David?
Right. So we've got our 7-step process that we've put together. And so we're going to walk through each one of those conversations in order to make sure that we best understand who you are, what's going on, and how to best serve you and your particular needs, because everyone's situation is different. And by the way, there's no two financial plans that are the same that resolve as out of this.
So after David's team does that fiduciary analysis of their CPR system or their ABC system, and we're going to do a fiduciary double check, then my team takes over to actually build the portfolio. So we're going to kind of expand on that now here for you. Yep. So again, here's the SAM services that are appropriate for an individual. And so David, you were talking here, maybe teaching a class about the retire. It's a good opportunity to maybe refresh people here on the first step of the discovery process with SPG's Retire.
Absolutely. So yeah, Retire, of course, stands for Retirement Education with a time-tested, independent, rational evaluation. The whole goal here is that we're trying to educate and empower. And that's what the goal of this is. That's what the goal of the classes are. We're trying to give you time-tested ideas. And so, you'll note all the little acronyms after Joe's name. That's not just because our kids got on the computer and started hitting buttons. It actually took a lot of work for him to get those things. But these time-tested ideas and results are what you're going to get here today. Now, this might be a little advanced for some people. I just ask you to bear with it, though, that you might be able to understand and have at least some of this perspective. We're also independent. And that's really important to know. We're not owned by a bank or a financial institution that says, hey, you have to push our mutual funds or our ETFs or whatever else. We get to independently review all 84,000 different investment options out there today. And that's what Joe and his team do. And they're really just putting this thing together in a way that's going to try to find, the most ideal solution for you. So, and again, it's ultimately rational evaluations at the end. So we've got the 7-step process. As you can note, it starts with income planning, then it goes to the investment planning. Now, I'm just going to mention these first two things really quick. Now, the income plan is actually your burn rate, your spending strategy, right? This is so important for us to get, because if we're going to get to step 3 and do some tax advantage planning, we've got to have an understanding of what's going out versus what's coming in, right? Because in order to do Roth conversion strategies, as an example, we have to have an idea of where things ultimately are. Now, between 1 and 2, the income planning, every real income plan has a diversified strategy that's fueling it, that's talking about withdrawals, and it's looking at the right risk management, everything else. But it is not true that every investment strategy has a real income plan behind it.
Absolutely.
And what most advisors do is they just say, hey, take the 60-40 portfolio because we said so, and this is how it's always worked out. And then ultimately, they say the 4% rule is the answer to all life's problems, which of course we talked about in class, and that's not necessarily going to be the right answer.
Speaking of class, David, a lot of guys and ladies have been through a wonderful series with you and your team, starting off with Medicare and talking about Social Security, going into retirement. And so a lot of people are familiar with that. A lot of people might not know that in our SAM model, we also have the capability to help, business owners, and really whether it's doing evaluation of the business, setting up 401ks, pensions. So anything else you want to add about the capabilities here, being maybe the last financial institution? I'm stealing your thunder.
There it is.
I won't steal. I'll let you take it. Go ahead.
At Sound Planning Group, we got to design our firm in whatever way that we want to. Again, that's what's powerful about being independent. And so you have the opportunity to build in such a way that's going to be most valuable. So we've designed our firm to be the last financial institution that you're going to need. And so it doesn't mean that we don't use outside resources like attorneys and CPAs, et cetera. Of course we do. But the goal here is to be able to answer and tackle all these really complicated questions, however advanced that they might be. And so, of course, we work with, specific individuals and businesses where this is incredibly important to get just right.
Yeah. I mean, most people have gone through the retirement course, right? But business owners have to retire too. And they face the same challenges, but with an extra set of more complexities because they own the business.
Right.
So no problem. We got you. We can integrate the retire system and the SAM model for an individual or for a business owner. Okay. Well, David, let's talk about the perfect investment. This is probably a quick review for the audience. A lot of you have learned this from David before, but let's just talk real quickly. Liquidity, it's always an important thing, right? And you never want to lose your money. Right. That's an important thing we talk about. Double-digit returns. Of course, can't guarantee those, but it'd be nice to have, a return opportunity.
When the market does participate.
When it participates, right? And then, low, no, or deferred taxes, right? So, what does that perfect investment take off? I think we'll go back and forth here. You teach this so well. So the first thing is, what do we say? Hey,
it would be 100% liquid would be the perfect investment. Next thing, it'd be protected. So no loss of gains in down years. And then, of course, when the market does decide that it's going to go up, that we can get double-digit return. And of course, we want to mitigate those taxes.
Absolutely. So we had our 8-year-old daughters are best friends, and we had them help us with the next slide. Oh my gosh, look what they did.
Doesn't exist.
It doesn't exist. That's the pink unicorn, right? So there isn't such thing as a perfect investment, but there is such thing as a perfect plan when you take the time to sit down, right, and with a trained institutional fiduciary and get all the critical facts.
Right.
You're going to be okay.
Bingo.
Right. So I think the question that you usually ask in class, David, is, what are you willing to give up? Right. Most people go, I don't want to give up anything. I want my cake and eat it too.
Sure.
So how are we going to do that, right?
Well, we got to find the right balance between the right portfolios. So we need the right amount of cash. For most people, it's 3 to 6 months unless we got big purchases going on. We checking, savings, money market CDs. Next is our protected assets. Now, these are kind of an interesting one. We spent some time in the principles class going through this because, CDs are an option that's a protected FDIC insured, but a lower rate of return, especially right now, and also very tax inefficient as we discuss some of that. And then we've got some of these structured products, index linked accounts. The goal is to get some protection with reasonable rates of return. And so, these kind of ebb and flow based upon the amount of risk that we want to take, the season, where market cycles are, and ultimately category C the red money side of this could lose money, but also can make great money. And so stocks, bonds, mutual funds, exchange traded funds, and real estate will fit into these models. And so what Joe's going to do is he's going to talk about how there are different ways of managing money that we can ultimately evaluate and look at in order to get the, mathematically the better answers.
Absolutely. So, the key thing here is that we have portfolios for A, we have portfolios for B, and we have portfolios for C. And so we usually like to start off by asking you, who do you think you are, right? So, David, choose your allocation, right? And so this is an example, and every one of you is different. But some of you may say, well, I want 10% liquid, right? And then when it comes to protection, I want 50%. And when it comes to gain, I want 40. And so what we need to do there is we just can't take what you tell us or give us and say, yes, sir, let's build you that portfolio, because we need to do a fiduciary double check, right? We need to make sure that your desired allocation is going to be balanced up with your ability and willingness to take risk. And so here you'll see that we're gonna test your hypothesis. We're gonna test your ABC plan. And so what we do is we look at your willingness to take risk, your ability to take risk, your spending level, and then basically we turn that into what we call your lifestyle return benchmark. And David, what that is for those that don't know is that's your unique number to make your life come true. So you're starting off today with a bunch of money, right? And you're going to die at some point, and you're going to either die broke or leave money. So you got a beginning and an end. And then during the middle, you're going to have cash flows. You got to have retirement income, pay mortgages, right? Maybe you get a reverse mortgage. Maybe you buy long-term care insurance. So you're going to have things coming, money's coming in and out, right? So we take that beginning value, we take all those cash flows in between, and we take that ending value, and we reverse engineer that into your unique portfolio. Okay, your unique number that means something to you. What the S&P 500 does has no bearing on your life, but your unique lifestyle return benchmark does. And this is where, David, over the last 30 years, I've seen the financial industry make a big mistake, and we're going to see in a slide coming up, that they only focus on the willingness to take risk and they don't know how to calculate this ability. This methodology, people, comes from pension plans. This is how institutions reverse engineer how they're going to structure their portfolios. So if it's good enough for the endowments and the large pension plans, we've just created a way through our SAM model to bring this down to the kitchen table and help you folks.
Well said.
Okay. So anyway, let's just say here you need 8%. We're going to build you an 8% portfolio. If you need 5%, we're going to build you a 5% portfolio. Okay.
Yeah, I think a lot of times people are thinking, hey, what amount of money should I retire?
That's right.
And it's actually your lifestyle return benchmark. If you can get that number to match up with what you've got. And that's really where the hey, should I work another year or two or make this decision versus another? It's that type of conversation that's really going to guide that.
And this is where the integration of the financial planning meets the building of the portfolio. And everyone asks me, hey, Joe, you got 30 years experience, you wrote 5 books, you have 9 credentials. What's the best investment? I'm like, have you done your financial plan yet? And they look at me like, what? I'm like, well, the best way to build your portfolio is to start with your financial plan. They have to come together. So let's talk about the synergy of those. So here's our fiduciary double check. So David, here we see that this person wanted to allocate 10% to bucket A, 50 to B, and 40 to C. Now, my team comes in and says, okay, we're expecting from the capital markets, the math and science, that we think that bucket A investments can do 1%. And we think the investments in bucket B can do 4%. And then the investments in bucket C, maybe they can do 7%. So if you put 10% of your money earning 1, that contributes 0.1% to the portfolio. 50% of 4 is 2, 40% of 7 is 2.8. So when you add this up, you'll see that this person's portfolio is just shy of 5%. Well, if you needed 6 or 7%, you can see we're going to have to go back to the drawing board on your ABC plan, right? That allocation to A, B, and C isn't going to make it, and so we need to adjust a little bit. We're going to come back and really bring this point back to life in a few minutes, but hopefully that made sense. We've allocated some monies to A, B, and C. We gave it a fiduciary double check to make sure the math and science would match up. And then we know if we can build you a portfolio or if we have to go back to the financial planning process.
Yep.
So anything you want to add to that?
No.
Okay.
You got it.
So when it comes to, when it comes to building the portfolio, because now we've done your double check, we're ready to build, the right portfolio matters. And what we have here is we have 22 different core portfolios with 3 different tiers. So for the golfers in the audience, it's kind of like we have the drivers,
right? We
have the 7-irons, we have the putters, we have the gap wedge, we have all the clubs that you need.
Right.
Now you just need your caddy, your financial planner, to help you know when to make those shots.
That's right.
Okay. So 6 stock portfolios, 15 asset allocation models, and an individual bond portfolio. And we're really going to talk about maybe some individual bonds and bring back some class concepts here in a few minutes because bonds are at a very unique time. We're ready to start a historical bear market.
Yep.
And if you're going to own bonds, you want to own them like we do. You want to own them in individual bonds.
Right.
With an individual bond, if you hold it to maturity, you know what you're going to get.
Right.
So even though the price might go up and down on a daily basis, as long as we hold it to maturity and there's not a default, you're going to get that principal back.
Yep.
So in this environment, much better to be in individual bonds if it bonds at all. Okay. So when we're designing something, I think, David, you were saying it, best. We have a little bit of everything because the markets don't always do the same things. You want to share with us about that?
The best performing strategy in one year is likely not the best performing strategy in the following year. And when we hit certain segments of time, like let's just even say post 2020 right now, we've got all this change that's occurring right now in the earth. We need to have 2020 vision. What are some things that we need to be paying attention to? Inflation right now is a bigger deal. We've got interest rates at record lows. We've got, maybe there's certain companies that aren't going to be doing as well. And so we don't want to necessarily own the index, which has a bunch of everything. We want to own more specific individual positions or companies that we believe have the preponderance of evidence that they're going to do better.
Yep.
So
yeah, I love it, David. You'll see here a lot of we put focused in front of a lot of our investments because we really like to hold 5 to 20 stocks, right?
Right.
We want to pick the right companies, just not own a bunch of companies. So we do the research, right? Buffett used to say something about diversification that is for lazy people. You got to do the research. So here we're gonna do that. We're gonna do that research for you. So we have a focused dividend portfolio, focused growth, focused blend, value, faith-based is really important to us and is on the rise, as well as the ESG.
Yeah.
So those are 2 thematic portfolios that a lot of people might be wanting to take advantage of or looking under the hood.
And neither one of these is right. Neither one of these is wrong. They're just a strategy and a way of investing that might be right for you, your risk tolerance, your time frames, etc. So there are 6 individual strategies right here represented.
Yeah, and when you play a game of golf, you don't just play with your driver. Right. So here, when you build a portfolio, you don't have to just be in one portfolio. We might have some allocation to, more than one portfolio.
Yeah.
Which
is
We'll very typical. We'll blend them up. Okay. Yep. So then we have 3 different asset allocation models. And the reason we have 3 is that most advisors don't even know how to do asset allocation. They set it and forget it with a 60-40 model.
Yep. Buy and hold, park and pray, hope everything will be okay.
Or they follow a 4% distribution model, which we know is crazy.
Yep.
So we actually have 3 different ways to do allocation. If you think about the boats, a tugboat, it goes slow, right? But it's really safe. If you're out there in Lake Washington or out in the ocean in a tugboat and storm comes up, you feel really good. You're not going to sink.
Yeah.
Okay.
It's not going to toss as much.
It's not going to get tossed around. But when the sun comes out, right, it doesn't go very fast either. So you see the speedboat go flying by.
Right.
You're like, man, I wish I was. What the heck? I wish I was getting some return.
Yeah.
So tugboats are risk management, downside risk volatility for people that are worried about losing money. Okay. A speedboat. Well, if you're in a speedboat and it's really choppy and rough, you don't feel so good, right? You might sink. But when it's flat and the markets have good conditions for risk on equities, they're going to perform well. And then the sailboats aren't built on modern portfolio theory. And I know you talk a lot about that in class. So just a quick note here is that you don't have to do asset allocation the old way. There's better ways to do it, right? So again, the point here is we have all 3 ways. and we understand them, and we'll help you understand which boat you should be in.
Right.
And I think David said something a moment ago about, markets change. And I was thinking, David, about my boats here. If the market changes, all we have to do is put the plank down and walk somebody from a speedboat to a tugboat, right? So if you've been very conservative and the sun's coming out, it looks like there's less risk and you want more return, we put the plank down, we move you to another boat, right? Kind of call that rebalancing. But here, thinking about the plank.
Yeah, we can change up strategies.
We can change up strategies if necessary. Of course, we have an individual bond portfolio, and the satellites are really important. Focused real estate is a great way to handle
So when
inflation.
You say satellite, what that means is it's going to be a smaller portion of your portfolio, maybe 5%, possibly as high as 10, but you don't want to make a massive allocation to something. That's one of the areas that people don't really manage really well, is they get way too heavy in certain parts of the market.
Yeah, so these aren't your core, but this isn't the steak, this is the potatoes.
Yeah.
And the vegetables, the side dishes. So you have focused real estate, great way to create wealth and to hedge inflation. Focused metals, outstanding way to hedge inflation now.
You do this portfolio really right too.
Yeah, it is. So we can get details on that later, right? We have a Crosslink, which is a new energy fund, clean and green and black. Great energy is our number one sector right now. A lot's going to be happening in that sector. We're going to take advantage of it. We also have the alternative real estate. So we have a liquid real estate portfolio, as well as we do Delaware Statutory Trust and REITs and private real estate.
And that's for people that have income properties that they've been managing for years. We've got solutions that you might want to consider for 1031 exchange, diversifying based upon property types, locations, finding where the inefficiencies are in the real estate market. We love real estate.
And we'll have a whole class on this. In fact, I know we've done one before. We'll do a live one. We'll do a recording for you. So we love real estate. We own a real estate firm. We do a tremendous amount of real estate. Rowan Street is an old Warren Buffett partnership type of fund. So it's a good solid equity portfolio. Did 65% last year.
I mean,
so you can't argue with that. And
crushes
then
it.
Structured notes are something that most of you probably aren't aware of, because they're more of an institutional custom design tool. So we won't get them to now. It's just because we are an institutional manager, we have a lot of capabilities that most people aren't familiar with, because you're not going to get it at your local financial planning shop.
We're actually going directly to the market makers and building these ourselves.
We're direct, no middleman. Right. Okay. So let's talk about risk management. I think when we talk about this, the best thing to do is to keep it simple. What's our goal? David loves to say, well, it's very simple, guys. Let's ride those bulls and tame the bears. When the market goes up, let's participate. And when the market goes down, let's try not to participate.
That's
right? So that's all we're trying to do. And so when we're building these portfolios, we think they're better diversified portfolios, but they're based on being reasonable. Right? And so I think this is an interesting paradigm for people to think about, because we're not trying to build portfolios that just blindly beat the S&P 500 every year and just are fueled with rocket fuel, right? We're building portfolios that are going to be reasonable with returns and reasonable with risk over reasonable time periods for you guys, for reasonable people, right? And when you go to the locker room and you hear Mr. Jones say, I got this hot stock and I did 20%, forget about it. Don't worry about that, your financial plan and your fiduciary double check will lead you to the right portfolio and will keep you on goal, right? So it's really important to start, as Covey used to say, begin with the end in mind.
That's right.
Okay, so the goal, ride the bulls, tame the bears. David?
Yeah, I just was going to say that another way I like to say it is we're seeking to find 70 to 80% of the gain while missing 70 to 80% of the pain. I mean, when you put it in context like that, everyone goes, yeah, that sounds great. I mean, it's like the tortoise versus the hare. It's like, if you can continue to do the more consistent thing more often, even though you might not be the fastest in any particular time frame, the more consistent thing over time tends to actually win the ball game.
And I love this guy because he's setting me up for a couple of my slides ahead of time. So thanks for that setup. In a couple of slides, we're going to give you a numerical example of what David just said.
Yes, sir.
All right. So what's the problem? Well, the problem really boils down to what we call prospect theory. Prospect theory is the way humans behave. And they won a Nobel Prize for this. And what it says is that people are willing to take more risk not to lose money than they're willing to take risk to make money. Think about that for a second. Let that soak in. I'm willing to take more risk not to lose as opposed to not taking risks to make money. Well, that's a sure way not to make money.
Right. You can go broke safely.
You can go broke safely. I've heard that before in class. Thank you, teacher. Yeah. So, so we really have to worry about your behavioral biases. And there's no rules, no discipline. So, of course, we're going to bring all that rules, discipline to the table, and we're going to bring an institutional fiduciary process to make sure that we, solve the problem.
Yep.
Now, where's this evidence of this problem?
Right.
Okay. Well, here's a Dalbar study, and it shows that over the last 20 years that the market does 9% and the average investor does 2%.
Right.
Right.
So most of the time when we see our portfolios going up so much, we say, Dave, I've done a lot better than 2%. Trust me, I can see the balance sheet. But have you actually factored in how much you've contributed and how much you were matched by your employer? Because when we actually strip this back, that's what the Dalbar goes into, is they say, hey, the average person's just not investing that efficiently. Maybe it's high fees. Maybe they're making the wrong decisions for the wrong reasons.
Emotional reasons.
Emotional reasons.
Cycles,
yeah. And so, we just, again, want to get back to math and science. We're going to get a lot more of that upside and downside protection when we can.
Yeah, so it's nice to turn to independent studies for our evidence, right? That's as researchers, that's what we do. We're looking for independent evidence. So here's that independent evidence of people are people, and they make emotional decisions. 100%. So now let's look at the evidence that comes from Dr. Siegel, who wrote the book Stocks for the Long Run. This evidence shows that since the late 1800s or early 1800s, that stocks are the best place to be.
Yeah. No
so you got stocks up there in that big line up there. You got bonds, bills, gold, and dollar all below it, right? So I think the interesting question for me and my team and the research that we're going to show you now is that if risk prevailed, why don't people take more risk, right? Why don't we do that? And so here's what we found. Here's a chart from our Bloomberg terminal going back to 1953 to last year. And you'll see that it's a nice line. It pretty much goes up, right? So it looks like you get on, you just ride it up, no problem.
Yep.
Okay. Well, what happens is the blue bars happen. Blue bars are a 5% drawdown in the equity market over a 30-day period. And there's so many blue bars here that we can't avoid them.
Right. No way.
Right. And there's no way. So we're not market timers.
Right.
And there's no system that works all the time. So, excuse me. So if you're going to be in the market, you just have to know right now to expect some 5%
There's some
drawdowns.
ups and downs.
Right. That may worry you, but if you have your plan set up correctly, your ABC, remember you still have your A and your B. This is only your C money, right? So you got to let that money take the risk. Take risk where you're supposed to take risk and avoid risk where you're supposed to avoid risk.
Right.
Then we get, I think we hid the yellow bar, so we're just going to jump down to here.
Whoops.
So we were trying to cut some slides down there for you. So we have blue bars are 5% periods, yellow bars are 10% drawdowns, and red bars are 20. Now we can start to avoid the 20s. I'm going to show you in a minute why we don't really care about the blue and yellow bars. We care about the red bars.
Right.
Okay. So the reason we don't care about the red bar starts with the story of negative compounding. And that means what goes down 50% has to go up 100% to break even, right? David's taught that in class. So here you can see that if you go down 10, you need 11% to break even.
Right.
Well, let's look at the blue bar. The reason we don't care about the blue bar is if the market can do 7%, okay, it only takes 0.76 years to break even. If at a yellow bar event, a 10% down, you only need a year and a half. And so we don't feel that a year and a half or less is really going to prevent you from getting to or maintaining that work optional lifestyle, AKA retirement, right? So we need to be tolerant of some risk.
Right.
So here's the slide I was telling you about that David set up really well. So here's two portfolios. One is stable. It does 10% over 5 years. It averages 10%. The other portfolio is volatile. It's up 20, down 40, up 50, down 30, up 50. Right?
Average 10.
Average 10. So, Mr. Client, which portfolio would you like? 10% portfolio or 10% portfolio? I don't care, right?
Right.
Well, let's look at what each portfolio's compounding wealth did. You'll notice that the 10% stable portfolio ended up with $161,000, while the volatile portfolio ended up with a little bit over $113,000. So we're not percentage managers. We're wealth managers.
Yeah.
Our goal isn't to get you high returns. Our goal is to compound your wealth over time.
Bingo.
Big difference. When you go to Safeway to pay for your milk and cookies, you don't go in and say, well, I'm Mr. Maas. I manage a portfolio. I got 25% last year. Give me my milk and cookies. They're going to want dollars, right? They're going to want
Yes.
Real money.
Can't spend an average.
We can't spend an average, right? Yep. So averages and spending averages don't work, and you've learned that in class.
Bingo.
So here, David, is the real example from Bloomberg. So here again, we saw, here's our hypothetical condition.
Yep.
Here's the S&P 500 since 2000. And you'll see 50% down, you had to go up 100 to break even. Another 50% down, you had to go up 100% to break even. So you'd think, listen, over my last 2 periods, I had 2 periods in which I was up 100%.
Right.
Pretty good, right?
Yeah. No.
But, that's what we call the lost decade. Yep. It was 0 for 13.5 years. Right. So
imagine had you retired at the beginning of that.
Yeah, right.
You'd be in a very different situation than those of you who have been working and continuing to contribute and get dollar cost average and matched along the way in these down market cycles. Trust me, when you get to retirement, looking at this slide and understanding the downside upside, it's a game changer. Yeah, you will pay attention.
The sequence of return that you've learned about from the PRP class is really, what we're talking about here. And it's important stuff to understand.
Yes,
so,
sir.
All right, let's switch gears for a second. Let's start taking people through the 2 sides of the investment coin.
Yeah.
And talking about asset allocation and focus investing and fundamental and technical analysis. A lot of words out there that people might have heard before, but don't know what they are and not sure which one's right. So let's see if we can't break some of that down.
Sure.
So when we go into the investments, the number one thing to know about our SAM model is that we're a dynamic and adaptive process. The way we manage money today is different than it was last week and the week before that and the month before that and the year before that, because we have to continue to recalibrate our research processes and our portfolios to stay properly positioned to prevent that negative compounding and maximize your compounded wealth. Right. And so we have an institutional fiduciary process to do that. We evaluate both the investors and the economic conditions. We determine the asset allocation and the capital markets assumptions. We do the fiduciary double check. We develop an investment policy statement where we put this plan in writing so we know how to stay on course. And of course, we measure and monitor that portfolio on a continuous basis. Okay. So the way we like to think about things is heads and tails. There's 2 sides to the investment coin. On one side, you have bulls. One side, you have bears. One side's risk on, one side's risk off. Think stocks, think bonds, right? And of course, if we flip that coin 100 times, it's going to land probably 50-50.
Pretty much.
Right? But what do most investors really want? They want to be on the side of the coin. They want all that return, but none of the risk.
Right.
And that's kind of like that pink unicorn. Okay. So what are we going to do about it? Well, the first thing we can do is we can realize there's only 2 ways you can invest. You can invest with asset allocation, which is a risk-off strategy, or you can invest with focus investing, which is a risk-on strategy. Right. Asset allocation was made famous by Harry Markowitz, Nobel Prize winner, pie chart stuff, okay? Great strategy, but your returns are always going to be average. They have to be mathematically, okay? On the other side of the coin, we have Warren Buffett, one of the world's best investors.
Exactly.
What Warren did differently is he didn't go out and put a little bit of money in everything. He really had conviction on a few securities or a few stocks, a few investments, and really let them ride and compounded wealth. Okay. So what we have to do is just really figure out who you are as an investor.
Right.
Should we be all risk on, all risk off, or somewhere in between? We have portfolios for both scenarios, many portfolios for both scenarios. Okay. So really what we have to do is that, Mr. Jones, he might be 60% risk off and 40% risk on, where, Mrs. Smith, she'd prefer to be 30% risk off and 60% or 70% risk on, right? So your ABC plan is uniquely customized for you, and we do a double check to make sure that it's appropriate. So here's where we're looking at willingness and ability to take risk. And earlier, I was talking about the industry's done us a big disservice. What a lot of people do is they go out and take a risk questionnaire and they score something. And we put you in a box and say, you're moderate, you're aggressive. Well, here, if you're a 40 portfolio, what most advisors do is they go to their playbook, they find a pie chart that says,
moderate conservative,
40, right? And they put you in it and you think, this was great. My fiduciary, I scored a 40. He found me a 40 portfolio.
Right.
And all is good.
And we just trust that that's the best answer.
And we trust that's the best answer. But with further analysis and looking at the preponderance of the evidence, we notice the other side of the coin. Right. The other side of the coin says that you need 9.35% to make your lifestyle return benchmark come true. Okay. Okay. Well, let's figure this out. You're in a portfolio that's going to do 4 when you need 9.
Not going to work out so well.
When are you going to figure out that you failed?
Probably about 10 years in.
Yeah. When do you need a parachute?
before you jump.
That's right. And by the way, David just jumped last week. So,
I did.
Okay. And he had a parachute. So here what we're saying is you have to look at both sides of the coin. You definitely have to worry about that tummy test, David, the willingness to take risk, but you also have to look at the ability, and that's the financial planning. And again, this is where the SAM model brings everything together. Okay. Right. So we're respective of both your willingness to take risk and your ability to take risk.
Bingo.
A lot of people say, okay, I don't want to violate my tummy test. So what do I do when I need 9 and I can only get 4? No problem. We go back to the drawing board. We have client education. So you can save more, retire later, spend less, or die sooner, right? No one chooses that, of course. And of course, we can try to have a better portfolio built based on all the critical facts.
Right.
Okay?
And if we can get the income plan right, maybe we can take that 935 that's needed for the lifestyle return benchmark, reduce some taxes, maximize some Social Security,
Roth
dial this thing in,
optimizations, conversions.
Maybe that drops down to us 6.35.
Yep.
So that's really where the rubber meets the road.
Yep, that's the magic of the 2 fiduciaries. You have 2 people that are looking at this instead of just one.
Precisely.
Two minds are better than one. So again, risk isn't a point in time, it's a continuum. So some people might be 100% risk on, 100% risk off, or 50-50. And so let's just look at a case so you can understand what it may look like, a 50-50. So here's a portfolio, 50% in a fixed index annuity that might get 4 but can never go down. The other 50% is in the market. Maybe it can do 7 and maybe it can go down 20. These are examples, hypothetical. So if the market's up, you're going to get 5.5%. And if the market's down, you're going to get -10. So that's how a 50-50 portfolio would be balanced out.
Right. And so, Joe, as someone with all these credentials after your name, you just talked about a fixed index annuity as a bond alternative. Now, that's like a swear word in some crowds. I mean, we got guys like Ken Fisher running ads saying, I hate annuities and you should too. And you just brought this up as a real bond alternative. Talk to us about that real quick.
Well, yeah, David.
I know you've got some slides coming up.
Yeah, we have some slides. Yeah, we got some slides. Luckily, we always have questions that we have slides to answer with. No.
Yes, sir.
Well, we look at investments as investments, and we don't care what they are. We look at either heads or tails, risk and return characteristics. So a stock has, let me take a half step back. Most investments provide either a return characteristic or a risk management, a loss prevention characteristic. Some provide both, okay? So we don't care if it's a stock, a bond, an annuity, an emerging market, an ETF. We don't care what it is. What we look through the labeling, right?
What does it do?
What does it do? What are the mathematical and statistical properties of that thing, that investment? And then we make sure mathematically that we put the right combinations of those things together.
Right.
Okay. So we'll show some evidence of that in a few slides. And again, we don't care whether an investor likes it or dislikes it. You're hiring us as an institutional fiduciary.
We're financially agnostic.
We're financially agnostic.
In money.
That's right. So, and that's the only way you can do it, right? You can't come to the game with an agenda. You have to come, look for the critical facts, look for the evidence, and then apply that to a sustainable, duplicable process that's independent and fiduciary.
There it is.
And that's the SAM model.
And when you're independent, you tend to come up with different answers than someone who's captive and selling whatever headquarters says. And
that's right.
Three layers of people that are between you and New York where they're actually doing the work.
Yeah, and just for a quick reminder, we throw that word around a lot, and we probably expect people to know what it is, fiduciary. That just means that by law, we have to do what's right for you. When we get audited, the auditors look to make sure that we have evidence in our file that we made proper recommendations for you and that we weren't salespeople. So we're not earning commissions, we're earning fees to be a fiduciary, okay? So another quick one up is a fundamental and technical analysis. I'm not gonna explain what this is right now. Just realize that there's 2 sides of the coin. At one point in the cycle, me and my team might be using all fundamental tools.
Right.
We might be using all technical tools or 50-50. Right. So as the market ebbs and tides, as risk on and risk off come in and out of favor, we adjust our research process to be what? Adaptive. Like I said when we started, we want an adaptive process. Okay, fundamental and technical, we believe in both. And just a quick story on this is that they're going the same direction. Or a fundamental analyst and a technical analyst are trying to go in the same direction. Right. So here's how the story works. A fundamental analyst finds a stock, is trading at 50, it's worth 100.
They think it's worth 100.
They think it's worth 100.
Yep.
They buy it. That pressure makes the stock rise. The technician then jumps on the stock and makes it rise to 100. When it hits 100, the fundamentalist says, well, it hit my target.
Got it.
I got it. They sell it. Shortly thereafter, the technician jumps on and the stock goes back down to 50, and we do it all over again. So actually, a fundamental analyst and a technical analyst need each other. It's kind of like yin and yang, right? It's two sides of the coin.
Neither one, again, is right. Neither one is wrong. The point is that these are the two different methodologies that move the market. Why are people buying?
Correct.
And so the fundamental is we've done the analysis. We look at the CEOs and the team and the company and where they're positioned and how their outlook is. The technical is, you know, the movement of the market and whatnot. So when you see it going up, you buy. When you see it go down, you get out.
Yeah. And David, you did go over that briefly. So thank you for recapping that. Again, for those of you that want to go back and look at what
when to buy, when to sell.
Yeah, what is fundamental, what is technical. You can look at the bullet points on that slide.
Bingo.
Okay? So active, passive. Now this, David, this is another one, heads and tails. It's hard to be active and passive at the same time. In fact, in our industry in 2013, there was 2 Nobel Prizes given, one to Eugene Fama for kind of passive management, one to Robert Shiller for active management. 2 great professors of finance winning the Nobel Prize, completely opposite sides of the coin. Who's right? They're both right. Who's wrong? They're both wrong. You know, what we do is we found the middle, right? You got to be measuring the market. Sometimes we need to be more active. Sometimes we need to be more passive.
Right.
Okay. Tax managed versus actively managed. When we're actively managing, we are trading. We're making decisions, right? We're trying to, you know, keep up with the market. Well, that's going to have a lot higher turnover, and in a taxable account, that's going to give you a higher tax drag.
Right.
So what can we do about that? Well, we can trade less frequently, right, in a taxable account. So maybe we're not staying up to date with the market. Maybe we go down and we buy and hold or something, but we're tax efficient.
Right.
So there's times to be more active. There's times to be more tax efficient. We have portfolios that do both. So again, when you sit down with your chief financial planner, they'll be able to help direct you on that. But it's just, we wanted to point out that there are 2 sides of the coin, and you can't be tax efficient and actively managing a portfolio in a taxable account.
Yep.
Strategic versus tactical, again, 2 sides of the coin. Sometimes we're more strategic, sometimes we're more tactical. Finding the reasonableness. The market can only do 3 things. Now, this is a Joe slide. This is a clock building slide. This is not a time telling slide. So I'm going to try to make it very easy. The market can do 3 things. It can go up, it can go down, and it can go sideways. And wouldn't it be cool if we could identify that statistically? Well, we can. It's called serial correlation, and we can determine if something's trending or if something's a mean reversion. All that means to you is we understand what's going on. We know when to use moving averages. We know when to use oscillators. We know when to use the driver. We know when to use the putter. Okay? So I'm going to leave it at that. Very, very important slide statistically. This is really in the belly of the beast of the statistical analysis and the preponderance of the evidence. But market does 3 things. Up, down, sideways. We can identify that with serial correlation.
And to say that simply, there are different types of investments. Each one may move in a specific way, and we want to apply the right information and the right statistics to that specific type of investment strategy.
At the right time. Yeah, one of the mistakes is last 30 years, I'll find managers and individuals, they'll go out and they learn a moving average strategy. And they call it the golden cross. The inverse of that's the death cross, okay? And so they're using that. They're trading the S&P 500, and all of a sudden it stops working because a broken clock is right twice a day, and they keep doing it.
Right.
Well, they should have put down their big moving average tool and picked up their oscillating tool.
Right.
You still could have traded the S&P 500, but the dynamics had changed.
Right.
Okay, so you can still trade it, but most people don't understand how to statistically test for it. So they just keep hitting their head on the rock over and over and over.
Right.
Again, they're right twice a day, so they're just encouraged enough to continue with their insanity.
Right. And by the way, the people that you're referencing, the firms that you're referencing, are very intelligent, very well-funded, potentially well-known and household names. And they've just got a simple way that they're doing things, or a single way that they're doing things. And there's not a whole lot of different application of the math and the science. So that's why having someone like Joe is so important. And by the way, most people have never even had a conversation with someone that has the aptitude and the ability to understand both sides of these coins, and more importantly, how to apply them.
That's right. Well, thanks for the kind words, David. And he's right. The industry has usually put a barrier between the people making the decisions and you on purpose. And again, that's why our SAM model is so brilliant. It's flat. We're right here. We're talking to you today.
Yep. You know why it worked. You know why it didn't work.
That's right. let's speed up here. We want to get people back to the game or whatever else you got going on out there. So let's talk about asset allocation really quick, which is one side of the coin.
Yep.
The important part here is there's new ways to do it and old ways. Two sides of the coin. We know both, and we'll deploy whatever is appropriate at that time. It can be really fancy math. It can be really simple math. We got you covered.
Right.
Okay. So another way that we like to think about allocation is in the old way, view is that they didn't like annuities, right? Stockbrokers don't like annuities because they don't, they get paid commission to sell stocks. So they never want to put an annuity in the portfolio. Well, we're financially agnostic. I love the way you said that. So we look at annuities as just another asset class, okay? And it doesn't have to be one annuity. It could be 2 or 3 annuities, right? And so it can be a portfolio of a portfolio. So anyway, an annuity should go into consideration like stocks and bonds and large cap and international and government bonds and all the other usual suspects, okay? And so when we look at an efficient frontier here, which is on the y-axis, you have return. On the x-axis, you have risk. So you want low risk and high return. So living in the Northwest is a really place to be, good place to be.
Upper left corner.
And you'll notice here that we're plotting stock strategies, bond strategies, asset allocation, annuity, and real estate strategies. And you'll notice that far green left triangle on the left is the annuity, okay? It's a very risk adjusted friendly asset class, okay? So it has some great properties mathematically. In fact, when we take that and we make portfolios out of them, here we have 5 portfolios now on this line. You see 5 dots on the line from conservative, moderate, moderate aggressive to aggressive. And you'll notice that moderate portfolio has just about a 6% return with about, what do we got there for risk? We've got risk of about 724 and a nice Sharpe ratio of 0.8. Okay, so that pie chart up here looks like any other pie chart that people have seen. Well, that portfolio is made up of 41% stocks, 5% bond, 47% annuity, and 6.5% real estate.
Right.
Okay, so that annuity made it into the portfolio like any other asset class based on its risk and return characteristics.
And what you did is mathematically identify what these portfolios should consist of at this point in time.
That's right.
This is just a hypothetical example from a time frame.
That's right. And for that aggressive investor, it was 80% stocks, 5% bonds, and 15% real estate, no annuity. And for the conservative, it's something different. But we're letting the math and the process and the science dictate how we invest. Okay, it's not by some bias. Okay. Now, Dave, do you want to say anything about this? This is a fun slide.
Yeah, I like when we have sort of like the before and the after, and in this case, we're talking about diversification. A lot of times people just think, well, if I just have a little everything, then it's all just going to be better, right? And that's how we get an average return. We got the losers, got the winners, and you're just going to get an average of the two concepts. But in this case, what Warren Buffett made really popular is this idea of focusing on the areas that are going to be better performers, the areas that are going to be mathematically speaking, at least, have the highest probability for success. Like picking the all-star team, right? If you could just pick the best all-star players, what would happen to your team? You'd probably win more games. And so that's kind of the concept behind this. So
yeah, and so on the research side, again, the clock building side, because David just told you what time it was brilliantly. Fewer is better. Here we're seeing that 8 asset classes on the line to the left is actually more efficient than the 22 asset classes on the right. So what's happened over the last decade is that as the Fed has been helping us put fuel on the fire, making us maintain an extended risk on market, people have been feeling the risk. They feel like they have to diversify. And so they haven't been getting return. So they keep adding more and more and more things on the fire. They add more investments into their portfolio. And they think that that's going to have a better probability of success, when in reality, it's actually doing the opposite. So what's intuitive is not what's correct in this case.
Just even think about the way that you would cook. You don't just go to your refrigerator and just take some of everything and just throw it in. Right. What you do is you pick the right ingredients to make the dish that's going to be specific to the
recipe. And the reason we show you this, and we're belaboring this slide a little bit, is because this is the evidence for our sailboat portfolios. Our sailboat portfolios are focused, tactical allocation portfolios. And this is why we built them based on the math and science, not based on some random idea that we had. Okay. All right. We've got some. We're only here. We're not even halfway through, I think. But we're going to go faster here.
We're doing good.
I'm just kidding. Anyway, what's changing, David? We always like to talk about what's changing.
Right.
So stocks are changing every year. Stocks change. What worked this year may not work next year. But if you hire a manager to be a large cap growth manager, and value comes in favor next year, you don't want to own those stocks. You'd want him to sell the growth stocks and buy the value stocks.
Right.
But at Vanguard and the mutual funds, they can't do that. They have to maintain that Morningstar.
Whatever they said they were going to do in the prospectus.
That's right. So that Morningstar style box has to be maintained. Well, as independent active managers, we got to buy the best 20 regardless of where they're at. Okay, so we're not stuck to a box. We're not constrained to an ideology. We're constrained to doing the good old fashioned work, the math and the science, and the preponderance of the evidence. Now, this is just another way to look at some rotation.
These are a lot of fun to talk about. Okay, but we're going to try to make these as brief as possible. The quadrants and
we're going to stick to the time telling version.
Yeah,
stocks are changing. Okay. And what we do is we identify these stocks and looking for stocks that might outperform the index. We call that alpha. Bad, dirty word, I guess, right? So we can identify not only where the stocks are going, are they improving, are they leading, are they weakening, are they lagging, but in the very center here is the S&P 500. And so we can measure everything relative to that. So how is this company going to do relative to the S&P 500? And so the farther away your stock is from the S&P 500, the larger alpha opportunity might
outperformance.
The larger outperformance we might have. Okay.
Love this efficient frontier. So that guy, Harry Markowitz, that won the Nobel Prize in 1973, he basically was looking at the difference between, the risk that we take versus the return that we receive. So, in the perfect world, 100% stocks is higher risk, higher return than a bond portfolio, lower risk, lower return than the stocks. Now, what's interesting is this right here is representing different periods of time, decades in most cases here, and so this gray one in the middle. Man, this is what everyone's basing their science off of when they look at historical rates of return of this type of portfolio. So your portfolio is broken up into stocks and bonds by percentage based upon historical rates of return. Now, what's interesting though is that when we look at different time frames, like in this orange area right here, so that would be 1970 through 79. Look, the bonds and the stocks yielded about the exact same rate of return, right? The same level up. But look at the differences in risk. So would you rather have had more risk in the same return or less risk in the same return? Obviously less risk, more return. That's the goal. And so, and then there's some upside down ones here, like this red one. So 2000 through 2009, the bonds yielded higher with a lower return than the stocks. But what's beautiful about this is the correlation or the understanding that when we add, some stocks to a bond portfolio, we can actually improve the return with less risk. And so it's important for us to understand the periods of time that we're in and how this efficient frontier ultimately works out.
And since it's always changing, what we say, we're adaptive. We always have to redo the work to make sure we keep you on the right line at the right time. Okay.
That rhymes. We might have to say that more often.
All right.
The right line at the right time.
The right line at the right time. There we go. Asset classes change every year. So right here we see that, large cap was in favor for 2 years, then international bonds, then emerging market, then U.S. small cap. So
it trends leadership.
The trends leadership changes. And so we have to adapt. Same thing with sectors, right? 1 year it's going to be the consumer cyclicals, then technology, then healthcare. So again, we have to be paying attention to
real
this
quick
change.
Sectors. Our economy in the United States is made up of 10 primary sectors, and so that's what this is representing right here. So you can just see of the 10, kind of which ones are performing better relative to the others, and that's why we got this beautiful quilt here that doesn't just look like real estate always wins or whatever. It's a combination.
Yep. So our job is to try to figure out
rotate
and where we're going to be. Okay? Same thing with the sectors. We can see them here, the leaders, the laggers, and where they might be going. So it's an advanced way.
This is fun stuff to look at.
Yeah, it is. There's some really advanced brilliance here that's it's difficult to communicate.
Right.
So just let us
look at the pretty picture.
We always measure 3 times, cut once.
Yeah.
Okay.
Yep.
So We measure 3 times, cut once. Factors, again, they're changing every year as well. So with all this change, we have to monitor. We have to come up with a universe, David, of what we might be looking at, right? And so we're taking a worldwide view. We look at market capitalization, small, mid, and large. So we're looking at small companies, mid companies, and large companies.
Perfect.
We're looking at equal weighting companies, equal mid, equal large, equal small. And right now, if you look at our market update, we have a chart in here talking about what's working. Is it market cap or is it equal weighted? And there's lots of tells that we get from that by looking at all the math and science. Again, we're going to wear that word out at the end of the day so that you remember it.
Yeah.
So anyway, we're going to look at market cap. We're going to look at style, value, growth, and blend. We're going to look at global sectors. We're going to look at currencies. So we might be in large cap European banks. We might be in small cap Japanese utilities. We might be in the peso. We might be in the S&P 500.
Yeah.
We're really agnostic to where those returns come from. We're going to study the markets, study the math and science, look at their statistical properties, look at which side of the coin they're on or risk off, and then we're going to build you an appropriate portfolio that's based on your ABC plan and your fiduciary double check.
Bingo.
Okay. So here's a clock building slide.
I love this one.
Yeah. So here we're not just looking at one time period, right? We're looking at short-term movements, mid-term movements, and long-term movements of the market. We're not just looking at one signal. We're looking at multiple signals, okay? And so what you see here is you see the Russell 3000. Here's 10 of our indicators. Now, an indicator is either bull or bear. Thumbs up, thumbs down.
Right.
Bull or bear, right? But from this, you don't know what to do. Well, what does that mean? I don't know.
Looks like a bunch of noise.
Bunch of noise. So we have to have 2 layers of statistical transformation before we can kind of get the call, right? Down here, you guys get what this is, right?
Up, down.
Thumbs up, that's good, that's bullish. Thumbs down, that's bearish, that's bad. And if we're flat, we don't know yet. Right? The market can do 3 things. Go up, go down, go sideways. And here's how we can kind of look at that statistically. Go up, go down, go flat.
Now, this is specifically speaking about the focused tactical allocation sailboat models that we talk about here. And what's important to note is you just mentioned the 3 different time periods, short, mid, and long. So the way that I like to think about this is that, on my watch, I've got an hour hand, a minute hand, and a second hand. Neither one of them is right? I want to know where I'm at in a day, so I know the hour. I need to know where I'm at in an hour, so I know what the minute hand is. I need to know where I'm at within the minute, and therefore the second is appropriate. And so there are 3 specific strategies that we do based upon these 3 different time frames.
Yep.
And so this is what Joe and his team are sitting down and crunching these numbers on, is as far as there's different strategies for each time frame: hour hand, minute hand, second hand.
I love the way you put that. My dad was a carpenter, so he always taught me, again, measure twice, cut once.
Yeah.
When we're working with your portfolios and your money, we measure 3 times or 4 times or 5 times before we cut.
Right.
Yeah. So I love it. Okay. So here's something that we're going to be, this is a little little clock building, but really cool. So remember how we told you about the serial correlation and that certain signals work at different times. So here's some evidence of this. What we have on the left side here is we have 23 of the more popular studies: buy and hold, weighted moving averages, Bollinger Bands, Williams R, relative strength, MACD. These are popular academic studies, okay? And from the time period on the chart, the best way to have traded the market would have been the Ichimoku line, okay?
For this period.
For that period. And then buy and hold, then weighted average, and so forth. But look what happens. So I find something that works, and I'm like, I'm brilliant, I'm going to do it. As soon as I do that, look what happened to let's pick on number 3. I determined that the weighted moving average, that's my jam. That's my thing, okay? It was working really well under this time period, but it went to 9 under this time period. Simple moving average went from 5 to 7.
And actually it was negative. Total return was minus 9.
MACD went from 6 to 10. Relative strength, which is everyone's favorite. You hear that in CNBC all the time. You see it in every newspaper. Relative strength.
If only it was so easy.
It was 19, which means it didn't work well at all. So don't use it. And it went all the way to the worst. So this is what we're monitoring. You don't have to understand this. That's why we're here.
These are just different investment strategies and ways of investing that are going to produce different results.
That's right.
Which is getting more traction, which has less traction, is just slipping and spinning its tires.
That's right. So what we do differently is, instead of saying we use moving averages, and we're going to apply that to everything
and tell you how great it is,
what we do is we reverse engineer what's working and then apply that to what we want to trade.
Precisely.
Okay. Much better process than what you're going to get from most systems. Okay. Now, this one is Microsoft, and I picked that. So the first one we showed was a broad-based market index. This is an individual stock. The same principles apply. So a lot of people say, well, Joe, that was the market. Those are ETFs. What about stocks?
Right.
The same thing applies. Here you'll see that stochastics was the #1 way to trade Microsoft, and then it went all the way down to 14. So think about that. You think you're brilliant. You figured you've solved the investment puzzle, okay? And then the next period you fall flat in your face, and you don't know why, and you don't know what to do about it.
Right.
So we will be able to identify that, hopefully avoid it, and if not, quickly switch to what's working under that new regime, under that new market conditions.
Right. Okay. And I'm just going to say this because of where we are right now in history.
Oh, yeah.
Because of so much change occurring right now, understanding what's going on with just like the last 2 minutes of the conversation here is critical, in my opinion, for success in the future. This thing is, you got to stay up with the rate of change.
It is. And, again, I'm a clock builder.
Yeah.
Market can go up, it can go down, or it can go sideways.
You don't care.
We do.
We don't care.
We hope it goes up, but we have the tools and statistical processes to really identify it and to. Now, are we always right? No. Do we guarantee returns? No. Do we time the market? No. But you know what? We have a better probability of making a better decision when we're looking at both sides of the coin.
Correct.
And using all the evidence. Okay. So we're almost done here. What drives the market? We get this question a lot.
Right.
So if anything from today's class, you're going to learn 3 things. 3 things drive the market: inflation, interest rates, and corporate earnings. And the 4th is, does the Fed have your back or not?
Right.
Okay. So obviously, inflation is a big topic right now, as all of these bullet points are.
Right.
We are getting ready to record our quarterly update, which we talk about these every time. So you can go back and look at the SPG resource page, I think it's on, and look at our past videos. We will be doing another one here, and so I won't go into the details now, but just realize that those are really the 3 things that we look at, with the 4th being the Fed, inflation, interest rates, and corporate earnings. And so that's how we can kind of tell if the market has a higher probability to go up, down, or sideways.
Right. Now, I just want to piggyback off of what you just shared there, and that is that on a quarterly basis, a lot of people are like, oh yeah, my guy calls me on a quarterly basis, or gal. And so I asked the question, so what are they talking about? Well, they ask me how my kids are doing and, what's going on in life and if there's any big changes. And maybe they'll talk about the performance of what's going on. Yeah. Well, here's something that's really interesting. We found to be incredibly valuable for the families that we work with. And that is, we want to get together on a quarterly basis, and we endeavor to do this publicly. Of course, COVID kind of messed with that here in 2020 and some of 21. But we're endeavoring to get together so that we can talk to you about what's actually taking place. Now, we got people that live and die by these classes because they just so appreciate the wisdom and understanding that Joe and his team are bringing to the table as far as why are we doing, what are we doing, how are we doing, what are some new ideas and thoughts. And by the way, as new ideas and thoughts come up, guess what? When you're adaptive, you're bringing that to the table. And so our ideas and thoughts are not just throw the baby out with the bathwater. It's like, okay, let's take a look at the past. Let's understand where we are at present. Let's have a perspective of where the future is. Past, present, future. We have all 3 of those. We have more of the preponderance of evidence. And so we're really endeavoring to do this both in video form, just like this, as well as in the live classes. So you're never going to not know what we're talking about. In fact, we want you to get your talking points from us of actually what's happening in the world.
That's right. And we don't guarantee this, but I pretty much write something every week that usually gets out. Some of it gets filtered for compliance, and some of it's too technical, so that might not make it out.
That's more often the case.
But we do have, for those who want it, we have plenty of resources to keep you up to date. So, okay. So, we have a couple minutes here. I just want to quickly go over wrapping all this together. And this is how we build a system. So it always starts off with a philosophy. Know your goals. Know what you're building. Are we trying to build something for focus investing? Are we trying to build something on the other side of the coin for diversification? Right? Are we looking for mean reverting indicators, which is on one side of the coin, or are we looking for momentum indicators, which is on the other side of the coin? Right? So understanding both sides of the argument helps us build better portfolios. And then what resources do you have? As an institutional manager, we have the world's finest resources. Our research budget is big. We have Bloomberg's and Zacks and research, and we have research and data and MATLAB and programming and everything we need, where, if you're doing it yourself at home, you're just not going to have those resources. So you might have some of the evidence, you're just not going to have the preponderance of the evidence.
Right.
Another thing that we do as an institutional manager is that we get research from all of the big banks, right? Goldman Sachs, Morgan Stanley. We have all of their research. We trade with all those people. So, we had a guy at one of our classes one time say, well, I'm with Morgan Stanley, so you're saying you're smarter than Morgan Stanley. We said, of course not. Morgan Stanley's a great firm with great people. We have smart people too. The difference is that being independent, we are able to get to their research and trade with them, as well as Goldman, as well as JP Morgan, with whoever we need to.
It's not exclusive.
It's not exclusive. We're agnostic to the process. So our resources are very deep. And again, you have to have the resources to make your philosophy come to fruition.
I think it's really important to just even reemphasize, it's important to pay attention to what others are saying out there.
Absolutely.
Now, whether we apply it or not is relative to everything else, the preponderance of evidence that's being brought to the table and reviewed before these decisions are actually being made. But you can know that there's a real system and process of doing that.
Absolutely. Yeah. I mean, our decisions are all independent and rigorously researched.
Yeah.
But again, we have both sides of the coin. We have all the evidence.
And it might work better and it might not work as good.
That's right.
Sometimes if, a broken clock is right twice a day. I mean, it could be one of those moments where something is just, rocket shipping. But the point is that, hey, if the market goes up an extra 10%, that'd be nice. What if it loses 30 or 40 for you? Well, that might change your retirement. Yeah. And so what we're trying to do is manage both sides of this in a way that's going to accomplish the goals. That way, you can sleep at night.
Yeah. So our philosophy is that we have tools and research, our portfolios, resources on both sides of the argument, right? Heads and tails.
Yep.
Risk on, risk off.
Have to have
bulls
both.
And bears. And that's how we're able to compound more money and do what we asked or stated earlier, which was to ride the bulls and tame the bears. Okay?
Bingo.
The next thing is we have a lot of automation and systems and rules. So we use technology and AI and things like that, neural networks, things that are really on the cutting edge to help us make take these decisions and digest this information. And by doing that, it really removes that emotion.
Right.
Okay. We're not the emotional side of the relationship here. We're here for the math and science, right?
Right.
And so we bring in that discipline system. We bring in that consistency, and that allows us to participate in the bull markets and then avoid the bear markets kind of automatically because it's system. We don't have to go wait. What? We already have the answers. The math's already been done.
Right.
Okay?
So these are proprietary algorithms that you and the team have built to manage each one of these individual portfolios in the most efficient and effective manner for that strategy.
Yep. For that point in time. And when the data changes and the evidence change, then we have to recalibrate the portfolios.
Bingo.
Okay. That way we stay on the right side of the trade. Okay. And trend. Our disadvantages. Well, no system works all the time.
Right.
You can't just use a black box. So we don't just sit back and push the black box and hope that it's right. We have a team of people that actually put eyes on it and overlay that fundamental analysis with that technical analysis, right? So sometimes we're all fundamental, technical, blend. It's usually a blend of both. And then that past data is not necessarily indicative of the future. You have to be careful when you back test and don't overfit your models, right? And think that you found the holy grail just to realize that something shifts on you and you really don't. Tail risk. So, random events we can't model, right? There's no way that we modeled COVID.
Right.
No, we reacted quickly.
No one saw that.
No one saw that, right? There's things that we just don't see. And some of our prior talks, if you go back and watch our videos, we always talk about that every decade and every year there's something.
Right.
Some big event that's going to shock the market, Ebola and elections and wars and
Greece defaulting.
And there's always something, right? And so we can't model those random tail events. And that's impossible. So you just have to be careful that you don't think that you can. You don't want to be overconfident. You need to make sure you understand that universe of what you're trading.
Yeah.
Right. And know why you're trading it and should you be trading it. So you have to really truly understand the players on the bench, right? And know when to play the players on the bench. Always have your best players on the field at any given time. I know you like to talk about the Seahawks and offense and defense, which I think is brilliant. And so here we're taking David's same analogy of playing that defense and offense with the overall plan into how we build systems and portfolios.
Exactly.
Okay. And then back testing, you got to be careful that you back test correctly. System design, again, back test appropriately. You want to use multiple time periods. You want to compare always to the buy and hold because you always want to be honest, right? Well, maybe my fancy system didn't work as well as just buying and holding. So you always have to be intellectually honest and test that and make sure that you have that opportunity to add outperformance that we call alpha. Okay.
Correct.
Follow your system until it breaks. So if you have 5 steps in a system, you can't do steps 1, 2, 3 and then hope to get the right result, right? So we follow systems. If the system breaks down, we go and figure out what, through a feedback loop, what didn't work, and then we recalibrate that piece of the system.
Right.
Okay. So those rules count.
And part of that might even be, as we were talking about these 3 different time periods, you know, maybe the short-term one is getting whipsawed and it's not as efficient. It's losing more. So then we wait more towards longer term or midterm in that specific example. So there's just this dynamic between where
it's a dance, it's a flow.
There you go.
It's an ebb and flow of risk on and risk off.
Yeah, it is.
And we just we're your dance partner through this, right?
Yep. And so that's all done behind the scenes. You're not contacting everybody and saying,
you don't have to worry about it.
Yes, 12 times in a recorded line.
Yeah.
This is you're giving Joe and the team here the ability to make these trades for you. So what you'll just see is the transaction trades, which, by the way, we're not compensated for the trades. We don't care about trading. We care about keeping things in alignment for the right answers there.
Yeah. And then I guess really to sum up the last 2 bullet points here, everything we do is we're looking at a risk-adjusted return, right? Yes. That's reasonable. We're not just looking for the highest return potential because it has the highest risk. A lot of guys over the last couple of years got into option strategies where they were sold, hey, we make 80% on this, and they lost 80% in a day.
Right.
And they wiped out firms.
You can lose.
So we're not greedy. We don't need to go out and play that game, right? We're reasonable here.
Yep.
And so we're always looking for reasonable risk-adjusted opportunities across multiple assets, across multiple portfolios, risk on, risk off, so that we make sure your ABC plan comes true. You got a fiduciary double check, and you can stay calm no matter what's going on in the market.
That's right.
And you can sleep. I may not sleep, but we want to make sure that you do. So, with that, David, I think, thank you everyone so much. I really appreciate being here, an opportunity to let me out of the box and talk to people. David's a great presenter, and you all see him teach class, and, I'm a clock builder. So but given the opportunity, I love to speak with you, and I try to tell you what time it is. So I really appreciate David being here to make sure I stay on track and interpret. And we look forward to the next time we can do this. So any last thoughts?
Well, I just want to say thank you, Joe, for your time and putting this presentation together. And, again, there's 22 different portfolios here. This is not a simple task or idea of way of doing things. And so, again, the quantitative analysis that actually goes into this, the amount of time, effort, and energy, it's significant. All right. Most people, though, have never heard of money management quite like this. Maybe parts of it, perhaps different ideas from time to time, but they've not necessarily had an opportunity like this before. Part of the reason why is that in order to get this type of money management or the dynamics that we're talking about here, you typically have to have at least $5 million to go to one institution, to put all your cash into one specific place, to be able to get all this type of specific management. What we've been able to do at Sound Planning Group is we've been able to bring this down to the coffee table, to the kitchen table, to everyone out there. Why? Because Sound Planning Group is one firm managing far greater than $5 million. And so we're able to build this together and to do this. And so that's where this reciprocated relationship can ultimately work in the strategically aligned asset management. So with that being said, hope that you guys appreciated this time here today. We've done our best to try to share things in a pithy manner, but to provide as much information that we could, again, in a way that can hopefully be digestible. So with that being said, have a fantastic day. We appreciate you. Look forward to your thoughts and your comments. And if we need to get Joe on the telephone to talk about some of this some more with you, I think that we might be able to do that.
Oh, I love to talk to people.
Yeah, absolutely. So with that being said, appreciate you. Take care.
Bye-bye.